Hello, YouTube. Welcome back to the Wealth Catchers channel. Definitely happy for y'all to stop by. Hope y'all doing well. So we're gonna go ahead and dive right into it. So this video is gonna be a little bit different than what we kind of done in the past. We're going to go over some opportunities that I see in the market. So right now we know the narrative. Everything's AI, everything's data centers, everything people worry about IPOs for SpaceX, all those type of things. And I feel like, as investors that are trying to get into the market, we get lost in all that. But thing is, while the market's at all-time highs, there's been some dominant businesses that have quietly pulled back into potential opportunity zones. So that's what we're going to be focusing on today. I got 5 companies that you should know about, right? They're very well known, but they have hit some key levels, and I feel like they offer some opportunities to go ahead and build a position in and things of that nature. So markets like this is just an opportunity to remind you, while the market could be expensive, there are still industry leaders that could give investors a second chance, second opportunity to go ahead and get into them after they too have hit all-time highs. They've been disregarded, left for dead, things of that nature, right? So quickly going to rattle off the tickers. So I'll give that to you up front so you don't have to, sit through this if you're trying to get in and out. I know some people don't like the long form content, but that's my bread and butter. That's usually where I sit with. But let's go ahead and get the tickers out for you. And don't forget to like, comment, subscribe. So we're going to touch on Walmart. As we know, their defensive growth. They're known for their e-commerce expansion, advertising business. They definitely let us know how the consumer's doing. And Walmart has definitely, fallen to some points where we can see like an opportunity. So for them, the biggest thing is, even during economic uncertainty, people still need groceries, right? They're consumer staple. Can't go wrong with Walmart. And then a competitor in the space, but obviously they kind of have their own moat, their own type of situation, is Costco, right? So they have the membership model, they're a consumer staple as well. And they have a big thing too, which is pricing power. So one of the highest quality businesses on the planet, and a sell in Costco, kind of rare to find when we talk about in terms of stock price. And also there's another hidden gem about them. They like to give out a special dividend. A lot of people definitely miss out on that. And this is definitely a pivot, because if you've known me for a while, even personally, stuff like that, I don't like the foreign investments, anything kind of outside the US. I feel like everything's tied in. But there are some names that I like, pay attention to or look at, every now and then, like Mercado Libre. And there's another name here, which is Louis Vuitton, right? So ticker symbol LVMUY. That could be on Fidelity to find like that. And also you can use LVMH. So usually you type in the name, should still pop up for you. But we know who they are, right? So Louis Vuitton, they got Dom Perignon, they got all these luxury brands. So it's focusing on luxury spending, the global consumer, and brand power. At the end of the day, everybody wants to, show off what they got, quote unquote, show how wealthy they are by buying these designer products. And while everyone's focusing on AI, luxury has quietly been in a correction, right? They have been selling off hard. Then we're gonna go into Visa. Visa, it's the I feel like it's the keys to the kingdom, right? Digital payments, economic toll booth. Every time money moves, Visa gets paid. And then we're going to round it out with waste management. So definitely a big play on infrastructure. It's an essential service. No matter what happens in the economy, the trash still gets picked up. And, obviously over time, investors and people definitely underestimate how powerful that business model is, and basically how essential they are to everything. So let's go ahead and dive into it. We're going to go into the first company. And what we're going to be using most of this video, we're going to be charting as well. But most of this is going to be back and forth charting, and then also using the stock research tool on thewealthcatchers.com. Go there, go to the tools tab, click stock research, type your ticker symbol in, and then you get your entry point, stock analysis, SWOT, competitors, things like that. So let's break down Walmart real quick. So see, the 52-week high was 135. We're currently trading at 116.50, 116.57. Year to date, basically flat, right? S&P, we know, is closer to, I think, almost 10%, or a little over 10% year to date. So we're flat on Walmart. And then you see here, we have that 10% opportunity zone to go ahead and get in there. Excuse me. And then you can see on the daily chart, we have opportunities. 100 has been hit. It's close to that 200. It's close to that 253. Weekly, we still don't have that nice, strong weekly entry. But we're about, what, $16 away, 15% away. So it is coming, right? It's approaching. But definitely to go ahead and get some shares or put some dollars to it, whether you're doing shares or doing, dollar amounts like 50, 20, $10, or the case may be. But Walmart has hit that point to go ahead and start giving it some attention. Quickly go to stock analysis. So we do have a hold on it, right? Due to like what's going on with it right now. Then for valuation, seeing that it's trading at 32 to 35 times forward earnings. Definitely has a premium on it, because when you look at Walmart, even though it is a consumer staple, it kind of does have like a tech premium almost added to it. And then that could kind of make it expensive. So definitely you can see, some selling off into the name to try to reprice it, to kind of bring it back to reality. But for this video, we're most likely going to be focusing on the entry point and then the SWOT. So obviously we got the strengths here. They got unrivaled revenue scale, consistent top line growth, and revenue grew over the past trailing 12 months. I don't know why that was a tongue twister for me. 7.3% year over year. So that's pretty good. Dominant insider alignment, ownership stability. So 45% inside ownership, definitely pretty good right there. Let's see what else we got here. Let's go to weaknesses. Obviously, razor thin operating margins. As we know, running such a large operation like that, and for them to be, they're all the go-to is like the best and also lowest price leader in the market, right? Usually when people think about going to somewhere and saving money, they're going to go to Walmart, right? And unlike Costco, they don't have to pay a membership to go there. Anybody can just hop up, go to Walmart. And 99% of the time, you're going to find, what you're looking for. Because, as you know, they sell everything. They can sell anything for stuff for your car, if you eyewear, your medication for pharmacy, clothing, groceries, everything you pretty much need. It's pretty much a one-stop shop. Everyone thinks about, I'm going to go to Walmart, right? So back to over here is what we're talking about, was the stretch valuation right here, right? To grow fundamentals. So then brings up here, the market is pricing Walmart like a high growth tech company, which we do have that element, right? About we're going to go look into opportunities next. How we see that the e-commerce side of Walmart, like digital shopping and all that stuff. If you've been to the Walmarts, you've seen the people pushing around the carts, shopping for customers. They're shopping for multiple customers at a time. And if you go to the side of the building, usually just parking lots or parking spots, I should say, for people pulling up to get the groceries. You see the Walmart vans on the street delivering groceries. That is a huge thing for Walmart right now. And that sector of their business is growing rapidly. Inside the store, it's like almost a mini warehouse operation or fulfillment center type operation going on back there. And on top of that, they have the distribution centers. So that's where you get that whole, it's Amazon-like in terms of that tech valuation getting added to it. But again, the bread and butter is being a consumer staple. So that's why sometimes it could probably be viewed as, okay, this price is getting a little too high. Let's try to make it worthwhile, right? Get that PE down to go ahead and make sure that we're not paying too high of a premium for this stock or for this company, right? So we can look at opportunities. You got retail media, advertising, because even if you have the Walmart app, if you've been paying attention in there, there's ads being thrown at you when you're scrolling. They kind of find a good way to try to keep your attention and put things in front of your face to let you know, hey, this is going on. You got the Walmart Plus membership. There's a lot of perks to it. Same way it has Amazon has its Prime membership with some perks built in. Walmart also does have those perks built in there as well. And then once you become a member of it, get it. There's also incentives like for the employees. they have Walmart Plus for free. So all around, they have definitely dived into that Walmart Plus situation, and also even for the payment scales, right? As you know, you go to a Walmart, there's no Apple Pay, there's no Samsung Pay. They have Walmart Pay, right? So they've been able to integrate that into their system as well, where you're going to be paying for your things via the app, right? Like for me, I go to Walmart, I can just scan or use the app itself, and I don't have to pull out my card, none of that, right? We do have some international exposure here with Flipkart they got going on there. And then last but not least, the tariffs, right? That's also going to be shown over here on the weakness side. Because tariffs, yes, they're going to hurt them in a sense, because we know it's hurting everybody. Prices are going up, things are more expensive. But once that settles down, or it's a forgotten about situation, that's actually going to be a boon to Walmart, right? It's actually going to be something that's going to help them, right? Because they're doing all these things and operating how they're operating with this situation ongoing and all these things, right? And like we said, too, all the stuff going on in the Middle East in terms of what's going on in Iran and all that stuff. So they're still operating, and they're still one of the most valued companies in the world, right? People are still going to it every day. So imagine when things get back to quote unquote normal, right? It's just going to be more upside from there, right? So you got threats. Obviously, Amazon's always going to be a threat. They're going to be a threat to each other, as we know. That's going to be a back and forth thing. And then, how we mentioned tariffs here, supply chain cost inflation, which could affect their already thin margins. And we got labor costs. We know they are the largest private employer, or they are one of the largest private employers in the country, right? There's a strong chance you probably know somebody that works at Walmart, like in your inner circle, or you probably, how can I say it, maybe 3 people removed from someone that works at Walmart. So if you know a friend and that friend knows a friend, that friend's family member probably works at Walmart. So, and again, location, right? Walmart's, you'll find one if you live in a regularly populated area, every 15 minutes is a Walmart. Pretty much every 20 minutes. Is really rare for you to be somewhere and Walmart's not nearby. So those are some of the SWOT analysis situations for it. So that's strengths, weaknesses, threats, and opportunities. Let's go ahead and look at the chart real quick for it. So looking at the daily chart first, like you'll see here, we had earnings report down here, and then also we hit an all-time high. Right before that, they had their earnings, and after that, everything kind of went downhill, right? They gapped down. So we have this gap here that's going to need to be filled, and this gap is ranging from, $130 to $126. So when it does recover, it does come back up, look for it to come back into this gap, either get rejected and go down, stay within the gap, consolidate, or into the gap and continue to rise up to hit new all-time highs, right? So we can see here on the daily that we are sitting, let me change my pointer. We're sitting right around the 200-day moving average. And then this is going to be for the weekly. So that's on the 50 SMA when we switch charts. But this is kind of where it's finding a home base at right now. And then we can see today how it's trading. Nice green candle. So definitely had some buyers step in to try and push it up. And then we see RSI also indicated that we reached that oversold level right here a couple of sessions ago, which is probably why it is having some type of sense of bouncing back, right? Nothing's guaranteed here, obviously, but it did go through that period of all-time highs, gap down, sell off, hit a key moving average. Now it looks like it's trying to recover. Let's go ahead and go look at that weekly. So the weekly, you see here, had a great long run of being above the 50, right? Pretty strong. Again, all-time highs. And then we're sitting right here. That green line is the 50-week moving average right there. So sitting right there could be support. And then we either stay around here and consolidate and then bounce up. But this is a good indicator here. Hey, we support, but obviously as time goes on, Today is what, Wednesday. We're in the middle of the week. So obviously as time goes on, we can see how this plays out for us here. But again, a name that's removed, from the AI trade and stuff like that, but quietly has given an opportunity for people to go ahead and get into, right? So let's go over to our next ticker. So Costco. Costco, you can see year to date, we're up 12%. So kind of in line with market, what's going on with them, which is pretty good. Let's go down here. Current share price 961.31. And we have hit that 10% off opportunity there at 986.85. And then as you can see here, go to our daily chart, it's either below support or we're at those key levels. You can see 200, 253, 400, and then you go to the 100. This is our big winner right here. This is showing a very strong potential here for a opportunity to go ahead and purchase or build a position, right? Because again, remember, weekly shows a stronger indication of what's going on with that name or that stock that you're looking at. The daily chart, gives you opportunity, like I said before, to nibble, get a starter position, get a starting trade, whatever it is that you're trying to do with that name. But weekly definitely solidifies what's going on with that stock, in my opinion. So definitely had the opportunities there. Let's go ahead and look at the swap for it real quick. Obviously, a big strength for Costco, big moat for them is that membership. And that's also where that pricing power comes in. They have people, millions of customers that flood in. They can raise the membership fee. They're still going to pay it because Costco gives you that situation where you get more bang for your buck. You could buy in bulk, things like that. So $65 a year fee, loyal shoppers, and then also within that membership fee, there's tiers in there, right? You go executive club level, things like that. Let's see, Costco's revenue engine is accelerating. You see the past trailing 12 months hit $293 billion. The year-over-year growth of 21.5%. Very good to see that. And then balance sheet, obviously net cash positive. So $11.13 billion in cash versus that amount in debt. And then return on equity, you'll see that notice usually when you're looking at forms is ROE, 29.2%. So that's very good. They're able to, flip that money and get a 29% return on it. And then low beta. So beta is basically how volatile the stock is. Usually a beta of 1 is what's on par with the market. So anything under 1 means it's less volatile than the market. A beta over 1 means it's more volatile than the market. So if you see a stock with a beta of like 2, it's twice as volatile than the market. Let's go to weaknesses. So margins, structurally microscopic, leave little room for error. So definitely, same thing as with Walmart, margins are being watched closely. And then it says valuations price for perfection. Usually when it says that for a stock, it means like what customers, or I should say what investors are paying is price for perfection, right? So everything has to go right to justify the premium investors are paying for this, right? And again, this is another one. PE ratio, the trailing for this one is 48.43, and then the forward is 42.5, right? Again, how we mentioned about Walmart, that's tech-like valuation, right? In terms of looking at price to earnings. Because remember, price to earnings is the premium you're paying for every dollar they have earned, right? So usually historically for like the S&P 500, PE ratio is usually, I want to say it's like 22, 21. Over time, it's definitely started going up a little bit. Used to be in the teens, believe it or not, like the high teens. But I think right now we're in that low 20 to mid 20 is kind of like what's normal for the S&P 500. So again, it's just a metric. Definitely use it in comparison to other companies if you are going to try to follow ratios and things like that. So compare consumer staple to a consumer staple. Don't try to compare a PE ratio to a company that's in utilities. Don't compare a real estate company to a company that's in software. Like, don't do that if you are going to try to go ahead with that. And then geographic concentration. Costco is mainly in the U.S., as we know that. But that could also be flipped on its head as an opportunity. Hey, could they branch out? But for here, it's signaling it as a weakness, right? So then let's go over to opportunities again here. Yep, we just said it. International expansion. So Costco operates fewer than 900 total warehouses globally as of 2026, and signaled the potential for hundreds of additional international locations, particularly in unpenetrated markets like China, France, and Scandinavia, where the warehouse club concept is still early stage. So that's a promising sign too, to go ahead and hit untapped markets, definitely build out that TAM, that total addressable market for them. That just equals out to, if it pans out right, equals out to more money, more revenue for them to build, more memberships. So that's why long term, obviously, we can see Costco still keep being a powerhouse, still being, great in the space. E-commerce, me personally, I'm not too familiar with their e-commerce situation, but same thing as you look at other players in the space, like I said, your Amazons, your Walmarts, they have been doing amazing in that space, and other companies are going to try to follow suit if they could try to figure it out, right? So for Costco, how are they going to try to do that? Are they going to, deliver into more delivery situations? I see here they mentioned Instacart, right? But I don't see a Costco van or a Costco truck, having employees hop into a Costco vehicle and go do delivery, stuff like that. Like we said, Amazon, Walmart, they do in-home deliveries. People coming in, they're putting stuff in your garage, putting stuff in your fridge for you. That's gonna be hard to compete with. Even Target's now tapping into more heavily into the e-commerce delivery and groceries and stuff like that. So for them, it could be an opportunity, but I feel like it's not as big as an opportunity as they may come out to be, right? And then we got some analyst reviews over here for the next fiscal year. $325.33 billion with a B. And obviously Costco's ability to raise membership fees. And it seems like, in 2024, last September, in 2024, they raised that up. And then they obviously have that annual member rate where they keep on renewing, the annual renewal rate of 90% plus. So over 90% of the customers come back and renew that membership. Like I said, once you get into that ecosystem, it's almost like getting into the Apple ecosystem. You get so ingrained in it, so used to it. It's like they're very sticky. It's hard for you to leave. And also, like I said, if you build your life around it, so a lot of people, all they do is Costco, right? I remember when I used to live down south, we were close to a Sam's Club. Sam's Club is like a weekly thing for us, right? It's almost like it's a mini version of Costco, right? Same concept, same type of opportunity, but Costco is just different, right? In terms of the hold they could have on people. And then they have their private label, which is Kirkland. They've done a great job building that out as well. And it says that here, pharmaceuticals, health, wellness could expand the 25 to 30% revenue mix attributed to Kirkland, right? Driving higher margin sales. And then again, back to what we're saying, strengthening member stickiness and reducing dependence on branded CPG, which is consumer packaged goods from other companies, right? So basically creating their vertical integration, right? That pipeline of their own products, so they don't have to keep on relying on, the Coca-Colas, the Frito-Lays, the other companies out there, when they could just, if I can make my product, my signature product, as good as yours, why would I pay you this money to have someone come in here stock the shelf while my own employees are stocking the shelf for your product when we can make it ourselves, right? And we have a almost cult-like situation around it, right? People love Kirkland. Then we got the threats. Again, tariffs. You're going to probably see that a lot with some companies. Tariffs. Remember when it was going on earnings call, everyone kept talking about tariffs. And then for them, Amazon and Walmart, right? Because they're doing their own warehouse club adjacent offerings. Then we got Amazon's Prime membership ecosystem and Walmart Plus ecosystem that was growing quickly. I'm telling you, this is going like hotcakes. It's going crazy out there for those memberships, right? But Costco still has that, treasure hunt format. A lot of things you can only find at Costco, right? And then competing with wallet share. But I feel like people are going to divide it up a certain way. Either they're going to be hardcore Costco or they're going to pick and choose the players that go into the space, right? But at the end of the day, you're fighting for attention. And then Costco, labor cost inflation. I don't know if you've ever seen that graphic going around about how much they pay Costco employees. You got some employees making well over $20 an hour, right? I think some managers are making over 30. That's definitely going to eat into your cost, right? Again, you got someone like Walmart who employs most of the country or a good portion of the country, right? In terms of, labor force, and they pay, a very small amount in terms of dollar amount per hour. Got someone like Costco, pays a pretty high premium for their employees. At some day it's gonna, eat into your cost, right? So let's see here. Wage growth outpaces productivity gains will squeeze an operating margin already sitting at a fragile 3.7%. So yeah, and then the thing is, then paying those high costs in labor, that's another sticky factor. Like I said, you can flip these situations onto their head, right? Then paying that high of labor costs for certain employees or the majority of the employees, it's retention. Your employee most likely is going to stay. They're not going to be able to find that kind of compensation elsewhere. So there's a good, strong chance they're going to stay. But also, you kind of got to try to keep up with the pace of inflation. So depending on that pay scale, how quickly are they doing the pace of inflation over 3%? Let's go ahead and keep those employees. Are employees going to leave? But we'll see. But that is definitely something to pay attention to, that labor cost inflation. And then consumer spending slowdown, inflation fatigue, rise in credit delinquencies. So it's the same thing, right? How strong is the consumer going to be, right? Because again, they are paying a membership fee and they also have to go in there and shop and pay these prices. And also some people, you're looking at the people who aren't really having a family structure, right? You're looking at the people who are, household of one, a couple. They probably aren't going to be going to Costco like that, right? Or maybe they were, and I was like, oh, is it really worth going? I'm one person. I could go, to Walmart. I could do some of my spending at some, step down names like Dollar Tree, Dollar General, to go ahead and get my little bits and pieces of things that I need, right? So it's those type of stuff. And also, I forgot to mention with the last name we looked at, Walmart, we do have the little wolf catcher take at the bottom, which gives you a nice summary of all these things that we just went over for the SWOT. So let's go ahead, dive into the chart for Costco on the daily. So we can see here, nice hit to the all-time high. And then it's the same story pretty much, right? Same thing, this happened more so down here, but hit all-time highs, but right going into earnings, right? Earnings were just a couple of days later. Same thing with Walmart. Earnings was like probably about a day away. After earnings, took a little tank. This was leading into earnings. Started, I forgot to map out a little gap here. It was the same thing. They had, their situation was earnings was a couple of days away, and then they fell off. And also, some of these names are going to move in sympathy with each other, right? So Costco can move in sympathy with Walmart, depending on what Walmart says, and vice versa. So at the end of the day, they both are doing a nice post into how the consumer is, right? But we can see here with Costco that we are right at the 200-day moving average, right? We fell below it, reclaimed it a bit. We haven't closed above it. So basically, we'll see how tomorrow goes. This is today's candle right now that's going. So we have intraday, right? Gotten above the 200. We're right around the 253, 400. So obviously we want to see next future sessions us close above this, keep rising up, and then for them challenging this 100 and then they get above that. And again, concept is to try to get above the moving averages, right? But you want to get your positions and enter these names when they hit key moving averages, right? So again, this is what we focus on. Look at opportunities. You'll need to always chase something that's at an all-time high and have FOMO, fear of missing out. And then even if you have fear of missing out on a certain name, I guarantee you there's another name in the space or the name in an adjacent space, you know, that you can take advantage of, or a whole nother sector that no one's paying attention to. So we got here on the weekly chart, again, right here at the 100, it's kind of hitting that support here. So the 100 weekly moving average is acting as support for Costco at the moment. Let's see if it can hold it. Same story. Hold, trade, consolidate sideways. As you can see here, we had the consolidation here before we went ahead to that all-time high. Hit that, then that sell-off continued for it. But again, great quality name, right? So this is the when you're going hunting, when you go stock picking, things like that, you want to look for quality names, right? Granted, there's going to be your speculative picks, right? There's going to be your speculative names out there that are going to run, that are going to have great opportunities and buying opportunities. But I just like to go ahead with names that are proven in the space that definitely have a strong impact. So let's go ahead, switch this back to daily. Let's go look at the next ticker we got here. Excuse me. So here we got Louis Vuitton, right? So LVMH. As I mentioned before, we know what they do. Luxury designer goods, things like that. People love, you know, the purses, the outfits, the this and that. This is the place you want to go to. People are going to go ahead and spend their money to show the world fashion statements, how much bread they got, whatever the case may be, right? You're not gonna. I haven't seen a Louis Vuitton store closed down. You go into the mall, people like walk around with the iconic Louis bag. I went to Apple to try to get my phone fixed a couple weeks ago. You've got the little Louis bag sit on the little table where they make you go sit out for your appointment. People got the Louis bags on the table. It's just a fashion statement, right? And that's what you're playing on, right? You're playing on the fact that the consumers are going to consume, right? And that could be the wealthy, that could be the person that's struggling to pay their bills, whatever the case may be. If they want to go ahead and buy this type of designer product, they're going to go ahead and do it. So that's what you're betting on. So LVMH, as we can see here, currently at 107, but year to date, down almost 30%, right? It's been demolished, been hated. When we know over a long period of time, people love this, you know, these products and things like that, right? So as you can see here, we're definitely at the 10%, 20%. You know, you're gonna see green all the way through. None but straight entries, right? It's like screaming buy me. It's screaming that. So we're gonna look at stock analysis, obviously saying, hey, I'm gonna buy. So again, the world's preeminent luxury conglomerate has endured a brutal 29% year-to-date drawdown, driven by China demand concerns, currency headwinds, a broader luxury sector derating, right? So it's basically going through that very violent repricing of what their goods are going to cost. Is it worth it? Things like that. So the stock offers a historically rare entry point into a best-in-class franchise with unmatched brand diversification through near-term catalysts. Though near-term catalysts remain uncertain as Chinese consumer confidence recovers slowly. So LVMH is one of those brands where they need the world involved, right? They need the Chinese market. They need the Japan market. They're going to need the US market. So that's what they live on. International exposure is what drives them, right? So something like, you know, China market or China demand not being as strong as it used to be definitely is going to take a hit on them. Excuse me. So we got the strengths here. So unmatched brand portfolio. So when you go ahead, look at it, they got over 75 plus brands underneath them, right? So you go to the investor relations page, You go to their website and you're just gonna see so many names you heard of, seen before, whether it's music videos, Met Gala, in songs, whatever it is, they probably own it, right? And you wouldn't have even known that they own it. So free cash flow generation. So they did have revenue dip to 80.81 billion. Had a little small dip. We dipped to 80 billion. That's actually pretty funny to read that out there. But they still generated $11.7 billion in free cash flow, right? So free cash flow is that opportunity. It's free money. It's like I can do whatever I want to. It can go into R&D. It could go into dividends. You can see here acquisitions, share buybacks, where they don't need to go out there and go get credit, go get into debt to go ahead and do these type of things, right? Obviously, we got the diversified revenue engine. It goes over here, lists out some of the brands that we know and love, right? So you got Hennessy, Dom Perignon, we got Sephora, we got Louis Vuitton, Christian Dior, Celine. So all these type of brands, like I said, heard of and love, right? And then liquidity, right? With $13.52 billion in total cash and a current ratio of 1.58, good liquidity, right? So that current ratio kind of is, I want to say, it's like that working capital, right? It's the current assets versus current liabilities, and they have enough to cover everything and also, be good if anything was to happen, right? They had a healthy ratio in terms of that. Then you got the weaknesses, declining revenue, as mentioned over there, did take a little dip. And then, let's see, leverage profile warrants monitoring. So let's talk about his debt to equity ratio. It's not alarming, but the refinancing costs on this debt load could pressure margins. Okay, so when it comes to refinancing, that's another thing too. When looking at the debt, when do they come due, and also what fees or rates they're going to be paying when it comes to refinancing said debt. And then here, quickly read over that. And then you got the headwinds. Obviously, you got Cognate and Spirits demand. Yeah, so this is kind of diving into the drinking, right? Alcohol. Me, I'm in my 30s, so you've probably seen it too a lot. With the younger generation, they're not drinking as much as they used to, right? It's kind of like same thing with smoking, right? Smoking kind of got thrown out the window. People don't smoke. But you go back into the 80s, 90s, everyone was smoking cigarettes. In the 70s, all that stuff. Same thing with drinking. Drinking is nowhere near at a height as it used to be. And the fact that, they do have some exposure to wine and spirits, it could be like, oh, people aren't drinking that much. But the thing is, like I said, they have 75 plus names, right? I'm pretty sure wines and spirit isn't going to, bring them down, right? But it is just something to be aware about and cognizant of. So opportunities. Got the China recovery, right? Definitely a multi-year catalyst. But again, eventually they're going to come back into the market. Eventually they're going to, reclaim some share, things like that. You got Middle East and India. And when you look at, like I said, I personally don't really care for international investments, but you still have to be aware as an investor what's going on out there, right? So we got emerging markets. So that's your India, that's Brazil, South America, those type of companies. You got Africa, right, as a whole continent. Those type of situations, right? You want to look at those are emerging markets. These are customers and potential markets that haven't been tapped into yet, or they're slowly being entered and they haven't even matured yet, right? You can look at China as a matured market. You can look at the US as a matured market. Even Canada, Mexico, kind of more so matured markets. But you got other markets out here that are still growing, that are also, they're going to be growing also in wealth, growing in also money, right? In terms of having dollars to spend, things like that, technology, all that type of stuff. And that's going to flow to these other companies. The companies that are winning, that are at the top already, they're going to just get more share when those those countries and continents come online while they have more, right? So again, Sephora, we know them for makeup, things like that. That's another big arm for them right there. We know the makeup industry is huge. And then continued merger and acquisitions optionality. So again, he highlights that $11.7 billion in annual free cash flow. Basically, they could do what they want, right? They go out there, spend it. Go ahead, drop bread on something, buy it, add it to the portfolio. Why not, right? They have the money to do it. So we got the threats. So macro-driven luxury demand softens. It's not a short-term blip. So it's just highlighting again that revenue decline, that 4.7 revenue decline. Basically slow down on Chinese consumption, U.S. consumer spending fatigue, which, I don't know. Sorry, as a country, we love spending money. I feel like that it says not short-term blip, which I could agree. Could be extended, right? But it's just a blip still overall. When people are feeling confident, people are feeling good about their accounts, they got money in their hand, they're gonna go and spend it. That's just what we do as a people, right? So again, highlights tariffs, trade policy. As we know, 47 goes up there, always says something that's going to shake the market. It's focused, messing up global economy. People are freaking out. So it's that as a threat, right? You don't know what to expect, what's going to happen, and then also the long-term effects of it, right? How long it's going to be until things play out, work out, X, Y, and Z. And then saying consumer pullback threatens the fashion and leather segments volume base. So that's just another thing too about the consumer being, squeezed, right? So inflation, rising cost of living, cautious consumer behavior, and cautious consumer behavior globally risks shrinking this buyer pool, which we all know that's just part of it, right? And then eventually gonna bounce back up. It just cycles, right? And then we have counterfeiting. People have been having fake Louis, fake this and that forever. Counterfeiting has always been a situation for these luxury brands. There's not going to be enough counterfeiting in the world to knock this out. And also the ego people have with the whole, you got fake Louis on, you got fake this on. Like, it's not, that counterfeiting market is not going to ever get to the point where it's going to knock off the real thing, right? And then this could be a threat, though, the luxury resale market, right? That I could see that, right? People are okay. They're going to buy used Louis Vuitton, buy used whatever it is, right? Still the brand, Ferragamo, all that stuff. People will buy used. I can understand that, but still, the ego. Someone's not going to have enough ego. Some of the big egos, they're not going to buy used. They're not going to want to do that. They're not going to want to go ahead and say, I got my girl a used Louis Vuitton bag. No, they're going to go spend the $30,000 on the alligator skin that was sitting at the glass. Like, that's what they're going to go do. That's exactly what they're going to do. So again, you're betting on society's thirst for showing the world how much money they got, showing their wealth in terms of what they're wearing, right? That's what you're betting on for this when I look at LVMH, right? So let's go ahead and see if they see anything down here. Yeah, so opening line says it. LVMH is the closest thing to a forever business in consumer goods, right? 75 plus irreplaceable brands. It's like, I feel like this stock is giving you, like, it's screaming again, buy me, buy me, buy me, buy me. And again, that PE ratio, this is cheaper than the market. If you're looking at comparing to the S&P 500, 18.3 on the PE. That's a great deal. And again, generational buying situation where it's hitting all those moving averages. As we're going to hop on the chart for it, you're going to see what we're talking about. So I feel like this LVMH is definitely an opportunity, right? So let's go ahead, look at it real quick. Obviously, as you've seen before in the past charting videos, I've been trying to make it be consistent with the gold/yellow gaps here. We have a ton of gaps coming up here. These are the most gaps I've seen in a minute on a chart. So as you can see, these are all opportunities and situations where, again, it's going to enter, and one of three things is going to happen. It's going to enter, fall down, enter, consolidate, enter, push past. So that's what we're looking for. Again, we've been range bound down here for a while. We're currently under all moving averages. Back here we're oversold, but again, you can stay oversold for a minute and then we can just consolidate, right? RSI did climb back up, but it's not an indicator of anything that's happening. It's just we've been consolidating. Again, this is sessions and sessions and sessions of screaming buy me. And I know everything else is running. Why would you go buy something that's down 30%? It depends on what it is that is down 30%. Again, that's what we have to focus on. So look at the weekly over here. Standing in the weekly, see the consolidation. Got here, it's the same exact story underneath all moving averages on the weekly chart. And then all it needs to do is like gain some momentum, start climbing back up, breaking past through these gaps that we see on the daily chart, and then all-time highs, you know. And let's see when the last time all-time high was for this. This was at $200.76. And this was back in summer of 2023, right? So definitely has been in a 3-year drawdown, right? And yeah, we wanted to climb back up here, right? But again, when you look at, because again, this is over the course of 5 years, this is an opportunity, right? It fell here before, seen it run up, failed to maintain, fell back down here again, right? And we're again almost at 101, right? We're at 106 right now. That was an opportunity too back then. Ran it up. Whether you want to hold it for a trade, but again, for a long term, you're looking forward to get back up here, right? You're looking forward to, this is basically doubling your money. This is 100% gain built in here just for it to get back to a $200 share price. I think that's worth the risk. Again, it's not something where you go ahead and be like, oh, I'm going to go dump all my money into this. This is the one that's going to make it for me. No. Again, we're betting on the consumer, being who they always been. Someone that loves to spend money. That's what we're betting on when it comes to this name. So let's go ahead and head over to the next name here. So we got Visa, right? Economic toll booth, the one that basically controls the ways and the passage of money. It's them. Obviously, you got MasterCard, stuff like that. But you look at the back of your card, it's Visa or it's MasterCard, right? They're controlling the bread and they're getting paid on every transaction. So Visa down 10%, as we see here. Year to date, currently 310. We have hit that 10% off price here at 337. And again, when we look at here, almost screaming by me, especially when we got this 100 weekly moving average that's been hit. It's currently trading right below it, 4% under it. Daily has been telling you opportunity after opportunity. Hey, I'm here, buy me. But again, weekly is showing that strong opportunity right there for it. Then stock analysis, same thing. It's going to show here and agree, buy. So as we know, Visa is a dominant global payment network, trading roughly 17% below its 52-week high. Definitely offering a attractive entry point into a high quality asset light franchise with durable earnings power. Let's go look at the SWOT. So as I mentioned before, Visa is the toll booth of the global river of money. It's basically a duopoly. Like I said, it's them and MasterCard that have the network of everything, right? Every swipe, tap, click. They have done it so well where you don't use a physical card, doesn't matter. Using Apple Pay, we still on there. Using Tap to Pay, we're still on that. Using these quick checkout systems, I think one's called Click, one's Afterpay, using the buy now pay later, whatever it is, we got some of that. And it's amazing how they have this business. And I feel like it's definitely slept on, definitely not paid attention to. Visa is an amazing business, in my opinion. So strength, you got the financial engine. It's borderline absurd. A 97.8% gross margin. That's crazy. And a 67.3% operating margin. It means the business converts nearly every incremental dollar of volume into profit. Oh man, $20.84 billion in free cash flow over the past 12 trailing 12 months. That's crazy, right? You got the Visa Nets two-sided network, which is a self-enforcing mode that gets stronger with every new participant, making displacement by a new entrant economically and logistically prohibitive. So again, asset light, they don't have a lot of um, situations where they have to worry about that. So it insulates it from credit losses because it never lends money directly, right? It's not betting on the consumer to pay them back. It's just, I'm just your toll booth. I'm just processing your transaction, right? So rising delinquencies, consumer credit stress that hammers the banks do not erode their balance sheet, right? Oh man, I'm sorry. I'm just because all this I'm going over to, I'm going in like in real time with y'all right now as I'm reading it. 19.2% return on assets. Oh, bro, that's ROA when you're going to see it inside the financial statements and stuff like that. And 60% return on equity, bro. They killing it. So revenue growth 17.1% year over year. And then next year, the analysts are projecting $50.31 billion next year. It's, oh, they going crazy. Again, you got any weaknesses. There's always going to be some type of weakness there. So let's talk about debt to equity ratio. Then they're talking about the insider ownership of just 0.1%. Disconnect between management and shareholder interests. So it's a situation where you're looking at, do executives have any skin in the game? Are they buying shares? Things like that. And then Visa's revenue is directly tied to payment volume and cross-border travel. In a global recession or a prolonged reduction in consumer spending, basically how we saw with COVID, right? And they dropped 40% overnight in terms of their premium price segment for that, in terms of payment volume. But again, COVID was the situation where you couldn't go out anywhere, right? So another COVID happening, who knows, right? Who knows, right? We never thought COVID would happen. It didn't happen. But it happens. We saw what happened with it. And then the Visa bounced back from that. Yeah. And again, they control the toll booths. Every time you swipe your card, they're getting some of that, right? And then you got the current ratio, basically in terms of liquidity. And let's see here. They got $13.91 billion in total cash against $23.98 billion in debt. It's manageable because of their free cash flow, but it's not as much of a buffer that you would expect from a company of their size, right? So I can understand that. And then for opportunities, right? The global cash to digital conversion story is only halfway told. The World Bank estimates cash still accounts for roughly 50 to 60% of global transactions, right? So again, that's opportunity right there because a lot of people still are, as I just mentioned here, using paper dollars, right, to go ahead and pay for stuff. So it goes back to what we were saying about the emerging markets. So Southeast Asia, Latin America, Africa, parts of Eastern Europe, right? These are people who have not tapped into Visa's network in terms of having a card, in terms of having, Apple Pay or digital payment systems that Visa is going to be a part of, right? So we got Visa Direct, the company's real-time money movement platform, enabling push payments to billions of endpoints. It's targeting a multi-trillion-dollar market in B2B payments, so business to business, gig economy, the disbursements, and cross-border remittances. So that's pretty cool to see. And then tokenization, we talked about that. We've seen about them getting into the tokenization space when it comes to the crypto world and all that. So they're saying that tokenization and cybersecurity services layer represents a high margin, fast growing, value added revenue stream. And then AI powered acceptance and fraud solutions. So they just, I feel like it's a buzzword a lot of people are using now, just as AI powered, things like that. But basically just showing that they're tapping into AI and being able to use that and find a way to integrate it into their system. Then we got the threats. So regulatory risk, as we know, it's a duopoly. It's always going to be a situation where it's like, hey, why is Visa's lucky MasterCard exists, and MasterCard's lucky Visa exists? Because if it's just one of them, they're going to break you down. Like, that's basically what happens when it comes to these things, right? So Visa got to pull got to pull a Jensen Wong, start throwing some dollars at these other companies, help the little guys up a little bit. That's what Jensen does with NVIDIA. There's no way you can say NVIDIA is a monopoly because they have spread out the bread in so many ways. Whereas, like, I'm helping the whole sector, I'm helping the industry. So Visa, MasterCard might have to tap into that if they want to stay on top. So, and then we have the real-time payment infrastructures built by governments. So we got Brazil, India, Europe's SEPA Instant, and then the Fed now from the US. So these other networks are trying to be built outside of Visa's network. So that's a threat, that's something actually pretty real to pay attention to, because they start building their own domestic payment networks without Visa getting a dime. That's a viable threat. But again, it's the whole getting people to do that, especially for the US, right? And some of the countries that Visa is very big in. The emerging markets, they have a upper hand on that, right? So if, back to over here on opportunity, Southeast Asia, Latin America, Africa, and parts of Eastern Europe, if they build out what Brazil, India, Europe, SEPA, all these other countries they're talking about here, these guys do it, then it's a real situation, right? Because then now Visa has to try to pry you away from that situation. But if they get you first, you in the ecosystem, sticky, you stuck, it's up from there. So intensifying competition for MasterCard, obviously, we know that's going to be a thing. And then we have Stripe, Block, Apple Pay, Google Play, PayPal. They're threats, but they don't have their own networks. Like, again, you use Apple Pay, you're still using your Visa card on these things. All these things they just mentioned here, you're still using their card, right? Nice trailing PE ratio of 27. That's good to see there, especially when you compare it to the S&P 500. So it's about 28% down from 52 week high. So another great situation where they're trying to say this is a threat for it here. I look at it as an opportunity. So we got the wealth capture take here. Visa is one of the highest quality businesses on the planet, 97.8% gross margin, as we mentioned before, $20.84 billion in free cash flow. Amazing, right? So basically saying it's caught between compelling valuation and regulatory overhang. Again, I'm not worried about all that, the regulatory stuff and yada, yada, yada. It's, as long as, like I said, MasterCard's still around, they can't really touch Visa. They could try to do their stuff, but as long as they have someone else in the space doing the same exact thing as them, like, you have to really show me how I'm a situation, how am I being a monopoly. So we got here, pretty much highlighted this whole situation here because it seems like this is where it's having trouble. It's almost range bound right here. And again, this is, the bottom for it. If it goes down here and breaks below this, kind of got some situations, right? So, but we also could see here, had opportunity, got right up here to 253, rejected, sellers pushed it down, and then it's never seen daylight since. But we're right here at the 50 and 50 and 72 on the daily chart. So hold around there again. Let's start closing above these as we've seen over here and did in the past over here. But it seems like when it gets to these longer time moving averages, the 400, 200, 253, it's having a hard time, getting past those guys and staying up there. And then we did have that gap up here that we seen here. I didn't highlight it because the gap was already filled, but we seen this shoot up right here. This looks like it's after, earnings. Shot up crazy. Got rejected. Filled the gap pretty much completely. Sideways. Fell back down, right? That's the situation we're in right now for them. Basically looking at on the charts, right? We're going to look at the weekly. a weekly, that same consolidation window we pointed out, this is what it looks like on the weekly chart. So it's hugging the 100 week moving average. This is where it's living at. This is where it's staying at. Again, we wanted to get above here, close, push past this. Its point of resistance right now is the 50 and the 72. So Visa gets past those, we're pretty good standing. And back here, 375.51. Again, we're at 313. Get back up here, very possible. And then you can go ahead and zoom out, try to get a little quick look at history. You can see here, this is 2022 down here when it hit the 253 and rallied up. But you see here, pretty strong, staying above the 50 week. When it hit 50 week back here in August of 2024, stayed up, got real close back here in April of 2025, then shot back up. But you can see, stay strong. So this is the first time in a long time. This is the first time in about 2 years that we've hit a moving average, right, and get below it. So it started right around here towards the fall of last year, where we started breaking past these moving averages to the downside. And now we're firmly underneath one and kind of sitting at the 100. So that's why definitely popped up on my radar as a name to look at. Then we have the last one here, waste management. So waste management, them, the big green trucks, they take all our trash. Essential service, very much needed. The world can't function without it, right? You can't function without these guys doing the hard work they do to go out here, get our trash, clean up our homes, our neighborhoods, our cities. So big shout outs to them. But definitely an essential business, right? It's them. You got RSG. You got some other names in the space. Those are two tickers off the top of my head that I know the most of. But also, we know waste management is the king of this all, right? So waste management year to date is flat, only up 1%. Currently trading at 216. We do see that they hit that 10% level. And then same thing, daily, screaming by me. We got the weekly chart, 100. There go that number again, the 100 SMA. We at the level, right? Go ahead, hey, let me go ahead and see what's going on with this. Buy it. So again, not financial advice, not saying what to do, but this is how I believe you should go fishing, go looking at situations, looking for companies to go ahead and put your capital to, right? So let's go ahead quickly go over to stock analysis. This is giving a hold, right? But we know waste management is a high quality defensive compounder with durable free cash flow and a dominant market position in the U.S. waste services industry, right? So saying at current valuation multiples that remain elevated relative to historical norms. The risk reward does not yet favor aggressive accumulation. So again, as we mentioned before, all the entry points, right? These are entry points. This is not saying load the boat. This is not saying throw your life savings. I've never said that. Do not recommend it. But these are opportunities for you to consistently pour money into build positions, right? Build your foundations. You're never trying to catch the bottom on anything. That's me. So I definitely feel like that's a nugget. A lot of people should go through it when it comes to investing. So America's dominant trash to cash machine. Waste management leverages an irreplaceable network of landfills, transfer stations, and recycling infrastructure to quietly compound returns while the rest of the world generates more waste every year. So again, we got the wind built in. We have people on the planet that's going to continue to waste, throw away trash. This company excels at collecting that trash, whether it's recycling, getting rid of it, this and that. They're the ones that handle it all, right? So that's why they win. Strengths, unmatched physical infrastructure moat. They operate the largest network of landfills, transfer stations, and recycling facilities in North America. Assets that are nearly impossible to permit and build today. So basically that's that infrastructure layout, right? They've already, same thing when you look at Tesla, you look at the supercharging network, they already did the hard work. got the network in place. Look at waste management the same way. Apply the tech mindset to a company that isn't tech. They got everything already built out. It's going to be hard for the next man up or next company up to try to come ahead and duplicate this. You can probably take some market share. Here, have my pennies, have my quote unquote, have my trash. But I'm winning. I got the majority of everything. I got the most of this total addressable market. Nothing you could really do. So they have the competitive barrier that keeps pricing power firmly in management hands and supports a 40% gross margin. Very good to see that, right? So consistent cash generation despite capital intensity. So this is the trailing 12 months EBITDA. So this is the earnings before interest, tax, deductions, and amortization, if I remember correctly. So $7.66 billion in free cash flow, $2.14 billion. So again, free cash flow, every time we see that number positive, that is good to see. Because again, that's money you can do whatever you want with. So demonstrate the business's ability to convert revenue into real cash. So that's for dividends, share buybacks, and the transformational $7.2 billion acquisition of Stericycle in 2024 that they did. So again, you like to see free cash flow because again, company has opportunity to do stuff, right? Beta. This beta is crazy. 0.49%. Or 0.49, I should say. The volatility is almost non-existent, right? So this is what I mean by a defensive stalwart in your portfolio, right? Volatility is a poor man's best friend, right? In terms of if you want a stock to move up and down wildly in price and you can stomach it, you're trying to hurry put a couple dollars in, double your money real quick and get out, cool. But if you want something that's going to hold your portfolio, keep its value for the most part, something like this, a beta of 0.49, that's crazy. It moves half of what the market does in terms of volatility, right? So the market can be in free fall. This is barely going to be in free fall. That's basically what it's trying to say, right? So perfect. Acts as a portfolio shock absorber, right? Beautiful to see that. And then we see the grew revenue 14.2% year over year. That's always good to see there. Let's see, strong institutional conviction and annual support. So 86.2% institutional ownership. So that means like, your big guys, right? Your big companies, your big institutions have a strong stakeholder inside the company. And then you got 19 out of 28 analysts give it a buy or strong buy. And obviously they get their price targets here. So let's go to weaknesses. So highly leveraged, which limits their financial flexibility. But again, we've seen over here, they do have some type of financial flexibility, but probably not as much as you would like to see, right? So definitely, something that you have to pay attention to, but doesn't really concern me, right? Let's see. Let's talk about the cash flow isn't as large as we would like to. It's only, $2.14 billion. But, that's basically because of CapEx. And then they have a telegraphed of $3 billion or more in annual CapEx through its automation and recycling infrastructure build out. But again, this is a weakness, yeah, but it's going into something that is a growing industry, which is the recycling infrastructure. A lot of people do care about recycling, and also basically you can see how it's going on the planet, right? We're doing a terrible job in terms of recycling, reusing, and now the next layer, I feel like when you dive into recycling, it's gonna be recycling the recyclables. So it's like I recycle this, give it a second life, but we have to try to figure out ways to get a third, fourth, fifth life, infinite life out of these things, right? So that's going to be, I feel like, the next level of trying to make things sustainable, like true sustainable. Because truly sustainable, I feel like it goes back into the ground and, contributes back to the earth, right? It's not how people are doing what the sandals and they turn into furniture, stuff like that. That could kind of be sustainable, but if that gets thrown out, it can't, go back into the ground. It's not going to decompose and all stuff, those type of things. The people who develop that and figure out that type of situation are going to win. So this whole industry right here, I feel like is a big win, right? And also, they're going to be a company that's going to be leading that, be a big part of that, right? So that says they have thin net income growth, which, yeah, we see that. But it's nothing, again, like for the financial part of it, I'm not too concerned about all that, right? And then low insider ownership signals limited skin in the game. So again, it's another thing looking at our executives buying, things like that. We'd like to see more of an executive stake, whether that's from officers, CEO, C-suite level people in the company, right? So then we got the threats, prolonged high interest rate environment pressures, the balance sheet, of course. So we know high interest rates makes it more expensive to try to borrow money. And also for a company like this that's capital intensive in terms of building things out, they are going to operate with debt. So higher interest rates means more expensive debt, right? That's not something you want to see. They don't go hand in hand. But again, flip it on its head. When interest rates get cut, which they probably are going to be under wash, you're probably going to let Trump talk into his ear, cut rates. That's going to be a beneficial situation to them, right? So this could get flipped on its head too. So we got competitive pressures. Like we said, we mentioned RSG before. They're the second player in the space. They do, offer some threats to it. They got their own stuff going on, right? They're gonna do their own R&D, so they're investing in infrastructure technology. Obviously, we expect that, right? Again, we want to control majority of the space. You don't need to control all the space, right? So regulatory and environmental liability risk, of course, this is gonna be big. What are they doing with the landfills? How are they making sure that things are being taken care of correctly, right? Clean Air Act, all these type of things, right? We're not make sure we're not burning the trash, which is adding methane gas to the, ozone layer and all that type of stuff, right? They're gonna be for their whole life underneath that microscope. So that could lead to fines. That could lead to, getting your hands tied behind your back about what you can and can't do, what businesses you can acquire, what businesses you need to sell. So that's always going to be a type of risk when it comes to this type of company, right? Because they affect the environment, right? And then we got the commodity price volatility and recycling revenue. So spot market prices, right? So for cardboard, mixed paper, plastic, metals, which could swing dramatically, right? So situation if they're getting paid X amount of dollars for cardboard, they're trying to say if they're making $100 off of cardboard last week, next week they could be making $70 off of it. Just me throwing a random number out there. So they're saying that swing in commodities is a threat to them. But it depends on how much of a threat. If it how can I say this? It's only a huge threat if this is like a huge part of their revenue model, which it plays a part in their revenue and how much money they make, but it's not going to make or break them, right? So opportunities, obviously, renewable gas or renewable natural gas (RNG) and landfill to energy is a multi-billion-dollar secular tailwind, right? So again, having their hands on this and be able to flip that around, how can we go ahead? Landfill to gas, that sounds crazy. And then if you see it working in action and it does benefit, people are paying the money for that, the energy companies that may need this stuff like that, that's a great situation for them because who owns the most landfills? Them. They have gold legit in the version of trash that they could turn into gas, which is liquid gold for majority of companies around the world, right? So we got the Stericycle integration. So it gives them opportunity to unlock a $6 billion medical waste cycle. So Stericycle, they got the medical waste. I think they got things with the needles, all that type of stuff that they have access to, right? People need a way to safely get rid of medical equipment, things like that, or medical waste, right? So got recycling technology and automation as a margin expansion driver. So got that going for them. And obviously population growth, right? That's we need people. People are going to keep this growing. Even if, the future changes and all we got humanoids and this and that, whatever it is, you're still going to have trash. You're still going to have waste. And that needs to be taken care of. They're like a forever company. Like I don't see them. They're not going to go out of style. They're not going to you're not gonna look at it like, damn, why do I own this? That's my personal take on it, right? So down to the wolf catcher take. And after this, we're gonna be wrapping it up. I know it's kind of a long, drawn out video, but I do like doing these deep dives, and that's just me. Hopefully, you can sit through it, consume the information. But this is like an insight into the type of research I feel like that goes into researching the company, understanding why it should be part of my full portfolio, why it shouldn't. Do I think I could own this for 5 years? What's the cycle look like? What environment are we in right now? It's just, like I said, it's amazing to go ahead and do these type of things and to look into it. And this is what I do in my free time. So this is how I feel like people should go ahead and look at things. And like I said, tools nowadays make all this so much easier for you. Like I said, you go to my website, do it, and this gets generated for you. You can use Gemini, ChatGPT, Claude, Perplexity. Like I said, all these tools are available to you. YouTube, there's other creators out there that are creating the content. Obviously, cross-reference, go check again, double check for everything, right? Don't trust one source on nothing. Always go ahead and do your research. But it's amazing when you start doing the deep dives and understanding things. So to take on it. So both waste management kind of business a long-term investor can own and largely stop worrying about. Again, you go sleep, wake up 10 years later, be fine and happy, right? It collects, processes, and monetizes garbage for an economy that never stops producing it, backed by physical assets no competitor can replicate overnight. Again, it's that moat. No one's going to just come over here and build 30 to 100 landfills and be like, hey, I'm your competition now. It's not going to happen, right? Again, 40.6% gross margins, that EBITDA, 7.66 billion, the beta of 0.49. Talked about that. But again, we have that worry about the load of the debt load, because about when it comes to financing, stuff like that, when it comes to interest rates. But we know we're okay with that. Stericycle, integration, the heavy CapEx costs that come with it. And then let's see over here. Yeah, so we're treating any pullback towards that support zone, basically the 205 to 210, as a gift from the market for a business that will still be picking up your trash long after most of today's hot growth stocks are forgotten. So again, pivoting away from AI, infrastructure, data centers, this and that, who's going to win, who's the next up. That's where we're pivoting away from. That's why we're going ahead, diving into these opportunities that the market, has forgotten about. So look at this last chart to wrap up. So we'll see here on the daily 194.11, 248 was the most recent high for it. And then you see that here we're underneath all moving averages. So again, situation on a daily, hey, buy me. We see the 100-day SMA, huge obstacle, right? Got right to there and then fell apart. Same thing for the 50. Got there, fell apart. Let's go ahead and look at the weekly. So the weekly, right underneath the 100 SMA for on the weekly. Again, same story as we mentioned before. Needs to break above these, hold, and stay above. And then that's where we're going to go ahead and get some opportunity, right? In terms of it rolling back up to 248 to all-time highs or to break above it. But again, great company, great stock. And to wrap it up, we're going to go back over here to close out. But I do appreciate you guys, staying through the video. I know it was a lot of content, a lot of information to consume. Hopefully you took away some great information. Definitely appreciate you guys stopping by. If you have any comments, leave them down below for me. Don't forget to like, comment, subscribe, and we'll see you next time, all right? You guys have a great one. Peace.